Welcome to the Dividend Talk podcast, episode 139. Stocks we are buying while the market dips. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. And don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. You look happy. There must be something wrong with the banks in this world.
Well, it's popcorn time, don't you think? I mean, come on, when a bank bust in Silicon Valley, and I mean, I always feel sorry for the investors, right? But you know my opinion about bankers, but it's quite the story, right? This is a big bank. It's not a small one.
It's top 16th. The 16th largest bank. I mean, it's pretty big news. It's pretty big news that these guys have gone bust. And I mean, one thing that stuck out for me is I was quite busy in work, so I stayed away from most of the news this week, and I flipped online today. And one of the first things I saw before I even knew what happened with the bank is that their CEO sold roughly 4 or 3.5 million worth of stock within the last 2 weeks. That's crazy. How is this allowed to happen?
You know my opinion about bankers.
It's really frustrating. But I mean, he doesn't suffer any financial loss here. He actually makes a gain out of this, and then the bank collapses, and you have all these investors. You have lots of people losing lots of money. There's going to be a knock-on effect. The market, you can see that the market is in a little bit of turmoil at the moment.
You mean opportunities?
Opportunities for some investors, but not for all investors. You think people who are heavily invested in this bank, they might have lost a lot of money here.
Well, they were not listening to Dividend Talk.
No, well, this bank doesn't pay dividends either, so it would never.
But come on, you know how it goes, right? There will be now auditors, lawyers coming in. They will take most of the money that's left in the bank out of it. And what will be their conclusion, right? You know, when you look at the balance sheet, on the left side, you have the assets. On the right side, you have the equity and the debt. And you know what the conclusion will be. On the left side, nothing was right. And on the right side, nothing was left. Yes, so no cash left, and the assets were not really assets. Something like that. It's always the same with banks. But for me, it's just more like I'm entertaining in the end, because I don't invest in banks. So, and I know it's not nice to see people being hurt and such, but investing in banks is really difficult. It's really, really difficult. First of all, if you look at the violation tracker online, and you take a bank like Wells Fargo and such, you wonder how this bank could still be operating after so many violations. The normal layman would be already for 60, 100 years in jail. So for me, the whole ethics, and I don't mind sin stocks, like personally tobacco stocks. My wife just doesn't like it and such. Banks, it's like, I think the whole if you, let's say it like that, I think if you're all day working with money, greed kicks in and it becomes superficial, and I don't know why it all happened with this bank, but it's quite the story. And honestly, I'm really happy, because today we are talking about the stocks we are buying on a dip, because we are really seeing a proper dip right now going on in the stock market. And I have a target to buy high quality companies this year. So honestly, for me, it's a gift that keeps on giving, that this bank went bust. And I hope it will even become a bit more stressful over the weekend.
But that's the question. That's the main question, isn't it? Whenever we see big news like this pop, the question on everyone's mind is this the catalyst? Is this what is going to make the market crash. We have yet to seen it properly crash, in my opinion. We've yet to seen that catalyst. But is this it? That's the big question. We don't
I don't
know.
know.
Yeah,
I
we
don't
don't
know, but
know.
just a week of this kind of fun is good enough to buy my monthly purchases, right?
Yeah, of course. I mean, it's
Yeah.
it's going to create a nice little opportunity, particularly in one of the companies that I'm going to talk about that I'm buying,
Yeah.
because it's in the financial sector, and we know that that's
Yeah.
going to be a hit. So let's talk about that in a few more moments. I did want to bring up a tweet that you mentioned. I don't know if it was yesterday or the day before, and I found it really, really interesting. You you sent a poll out asking people if they felt like they owned their shares with their brokers, and I'll let you talk about the results.
Well, yeah, so 30% of the respondents feel that they don't own their shares. And honestly, I put this tweet on with this poll because it was going through my mind when I saw something about the hero that the financial institution, the watchdog, was giving them a reprimand or something like that again, that they should get their act together better. So I thought, like, you know, do we really own their shares? And so from time to time, we get it. I get this thought in my mind, right? Because everything is nowadays digital. You don't have a paper copy anymore. It's just a number on the screen, and then you hear of what happens with FTX, with the crypto and such. That what is saying, not your wallet, not your crypto, or something like that.
Yeah,
And honestly, I have no clue what's really happening in those brokers. They can tell me whatever they tell me. I just see a number on my screen. It goes up and down. Yeah, when I watch. But do I really own it? Yeah. So sometimes this thought popped up. And then, yeah, when I put the tweet out and the poll said 30% feels they don't own their shares, that's a large number. And if you then think about that, we are over time building up large numbers of wealth with these brokers.
yeah,
It makes me wonder, right?
yeah. But I mean, what was interesting to me is your follow-up tweet. You noted that 33% do not feel like they own their shares. You asked for clarification from two brokers in particular, the Hero and Interactive Brokers, and the replies were very different and very, very intriguing. So I'll read the Heroes first, and they said, "Hello," very politely. At the Hero, your shares are your own. We work with asset segregation in separate legal entities known as SPVs to keep investments from clients safe. Okay, I don't know if I believe that, but that's what they wrote. Interactive Brokers, on the other hand, again said hello very politely, and they said, while clients are the beneficial owner of all securities held in the account, all securities are held in brackets, street name, meaning they are registered in the name of Interactive Brokers. What were your thoughts when you got those two responses, literally one after another?
Yeah, I think they're actually using the same procedure. So for me, it feels like Interactive Brokers is more straightforward to me, really telling me in my face what it really means.
Yeah,
And the Hero, I think they are, in the end, those are my shares because I'm the beneficiary of theirs, right? What they have in their name. But yeah, I just get a better feeling with Interactive Brokers with this
yeah.
response.
I mean, both of them are the same, right? Okay, we do own the shares essentially, but they are not technically in our name. They are
Yeah,
in the street name, and I think the Hero is the exact same. It's just the way they explain it. It's I'm
yeah.
not going to say they're being dishonest, but they're not being as upfront as they should be, in my opinion.
Yeah. Yeah, I find it really hard to judge. For me, FTX was also saying these kinds of things. So in the end, they can all say this kinds of stuff, but if they're not having their admin in check, yeah, then we might still end up because of fraud, because of not no proper due diligence at the bank. In the worst case, we might still end up with problems.
Yeah.
Yeah. And there's no protection there because a lot of our money is maybe safe because it falls under the banking regulation, but when it comes to wealth in stocks, that's You know, if they really don't have their act together, you can just look for your money.
Yeah.
So what I'm doing in general, right? I'm diversifying through brokers. I've got 4 brokers at the moment. I've got Interactive Brokers. I've got the Hero. Those are my 2 main brokers where I've got the most of my shares, and then I have a little bit at Trading 212 because of the pies, the Noble 30 that I invest every month in, and I still have some at Saxo Bank, but I shifted already most to IBKR because of the fee structure there. But it did make me wonder, like, should I, for instance, register at ComputerShare and sometimes just buy the shares directly via the drip programs that that they are having? Because, for instance, I wouldn't mind having Shell at something like a ComputerShare or something like that, or Ahold has or something like that, because those will be long-term positions. I don't really see myself going in and out there. So I will look at what they offer at what broker and see if I can maybe shift my shares there and have them really registered on my name.
Yeah. For companies that you truly believe in and truly want to hold long term, and you're buying, let's face it, a substantial amount. You're not going to spend €100 a month at CompuShare,
No,
probably,
exactly.
but it is probably worth exploring that avenue and seeing if that is a better option. It's something that I might do as well, because it does get you thinking. I get this question a lot, as you do, particularly around the Hero Interactive Brokers and Trading 212. I always plead caution on Trading 212 more so.
Yeah.
But I'm still unclear. I'm still unclear of the consequences of what happens if these guys go bust.
Well, and in the end, these are low-cost brokers. So
Yes.
we just need to remember that. If
Yeah.
you go maybe to an ABN AMRO, a bank, you pay decent fees to it. You'd probably still pay like €10 per transaction or something like that, and maybe maintenance fee of 0.3%. So if you have a portfolio yield of 3.3%, you only get 3% netto then, right? But there, usually you can ask them to register, and then you get it all. Okay,
Yeah.
I know many people at German banks or Scandinavian banks, they have these options, but there comes a certain fee structure with it as well. But from the other side, it buys you safety, at least from that point of view. Yeah, so in the end, with that, therefore, I'm still going for low cost brokers because they are checked by the regulators who see it's working, because the Hero gets sometimes, every year or something like that, a warning that they need to get their act together. So it seems to be working. It's regulated, and that's important. But still, you see now if this SVB bank can still go bankrupt, yeah, and then you will really learn if you have access to your money.
Yeah.
But maybe another one. How do you get a banker out of a tree?
I don't know
You-
how.
You cut the rope.
I'm going to guess you have quite a few of these jokes to tell throughout the show.
Yeah, well, I will put them into the show today.
Awesome. Dividend hikes. We've got quite a few to go through. Maybe you might take us through one or two of them.
Well, first of all, Legal and General, the insurance company from the UK, they will pay a full year dividend of 19.37 pence, which is 5% more than last year. And this is really awesome because this company is already yielding 7.5%. So if you're talking here about a high yield dividend play, then and in a relatively stable sector like insurance, then Legal in General, I think, is really good. They have a progressive dividend policy, already quite a good dividend growth over the last decade. So nice one. And then we have dividend aristocrat Colgate-Palmolive, ticker symbol CL. They hiked their dividend by 2.1%. And followers of me should not be surprised. I did a video also about Colgate, let's say a year ago. I think this company is just overvalued. They had struggles after post-COVID. Cash flow wise, they're really having a high payout ratio. The dividend yield is now 2.7% going forward, and I'm staying away from it. Then if you are into, if you think that wars are an interesting investment theme, then General Dynamics is hiking their dividend by 4.8%. marking 26 consecutive years of dividend growth, currently a yield of 2.3%, ticker symbol GD. And also, if you think about the semiconductor sector, Qualcomm just hiked their dividend for the 20th time in a row. It's now up by 6.7% to 80 cents per quarterly per share, and it now yields 2.7% approximately. But let's go to some Europeans, because this one is always really intriguing me. Lindt and Sprungli from Switzerland hiked their dividend by 9.1%. But listen to this. They are going to pay you 1,300 Swiss franc per share in 2023.
Wow.
Yeah, so currently they have been rising their dividend for 25 years. I believe it needs to be in the Noble 30 index, so that's something for me to add. I've got some to remove as well at the same time. But what a money, right? I can't buy such a share. Anyway, your darling, then Schneider Electric, is paying a dividend for 3.15 euro per share.
Yeah.
And it will be now yielding slightly above 2% going forward. Curious to hear if you will be buying more. And we have two dividend cuts from Germany, Software AG, which is really a pity. They cut their dividend almost to zero, only 5 cents left. But they had 18 years in dividend streak. And I've been several times looking into this. I don't know the exact details, but I was really surprised to read that they made such a big dividend cut. And then in the community, they were mentioning about Adidas cutting the dividend by 80%, and probably because of Kanye West. I'm wondering, like, how do you explain this to your wife? Like, oh yeah, no, one of our portfolio holdings cut their dividend because Kanye West put a tweet out. Anyway, for me, we have spoken about Adidas in the show. I think we did one time also an episode about that one. It's not a dividend grower. They have a history of cutting the dividend. So I am personally not surprised. I would also never treat them as a dividend grower. But as you can hear, like quite some dividend hikes again. They continue to come also in March. And yeah, I wish everyone really congratulations. And I'm really curious if there's even one listener that owns one share of Lindt and Sprungli, the amazing chocolates.
Well, how much do you know the share price off the top of your head? I'm looking at it, so I know.
No, not anymore, but it was like a six-figure, right?
Yeah, you're looking at 100,000. 100,000 just
Hallelujah.
one share. So they are completely out of my budget. Their dividend yield is only 1.29%. So even though 1,300 Swiss francs sounds good, it's not good enough.
Can you imagine hitting the buy button in the hero for that one?
I'd be just to buy one share. It had the ability to buy one share would be nice. It'd be
Yeah, but then even if you have the ability to just realize what 100,000 is worth and push the buy button.
Yeah, I mean, the share price is quite stable over the last 5, 6, 7 years. You're looking, it's hovering from 80,000 up around. It hit a high of 120. It's around 100, but I couldn't imagine. I think my mental barrier would not allow me to spend that much in one go on one company, on one
exactly.
share.
That's what I mean. That's what I mean.
My mental.
But hey, before we go forward, this is one for you. Why are Irish bankers so successful?
I don't know.
Because their capital is always Dublin.
Hey, I wish that was true, because then I would invest in them, but that's definitely not true. And just one other note then, that Software AG, why bother keeping 5 cents per share? Why not just cut the dividend? Why not just get rid of it?
Because in 80 years from now, they can say that they have been paying a dividend for 100 consecutive years.
Yeah. Oh, hallelujah. Okay, let's move on to the main topic, and that is companies we are buying or hope to buy while the market dips. I might go first with the first one, and it's a company I briefly mentioned on this show before, and it is EOG Resources, ticker symbol EOG. Basically, they are a crude oil and natural gas company. They are founded in the United States, and crude oil, be no surprise, it makes up around 80% of their revenue. What I really like about this company is their management. Their management is top quality. They recognized during the last little oil crisis around 2018, they recognized that they need to improve their business, and they targeted these premium wells, is what they call them. So they generate more revenue, more money per wells, and they've done an incredible job at that since then. That in turn generates higher cash flows, and they are really, really, really shareholder friendly. Anytime they have any bit of extra cash, they pay special dividends. I think they paid something like $5.80, in around $5 anyway, last year, just in special dividends alone. Their yield at the moment is around 2.9%. But if you take into account the special dividends, they've already announced another one which they're paying at the end of this month. You get about an 8% yield on this. And if you look at their annualized growth rates over the last 5-10 years, you're looking at 35 and 24% respectively in dividend growth. For me, it's just a really, really well managed company. I love the management. They are really shareholder friendly. They have they have very little debt on their balance sheet as well, which is quite good. They've been paying that down quite aggressively. Lots of cash on hand, and yeah, it's definitely presenting. I wanted to buy these guys when they dipped around €100 last time. I didn't, and they shot up to about 150, but now they're starting to drop down to a more acceptable range for me. They're on my radar to start buying.
Yeah. So I said, how do you compare this then to your holdings that you have already, like Royal Dutch Shell and such?
Yeah, they're a completely different company than Royal Dutch Shell. These guys are drilling and purely in that. So Shell is a more integrated company, I believe. So it gives me a bit of exposure on both sides. If you like the environment and you don't like the likes of fracking and all this, you might not want to invest in a company like EOG Resources. But in terms of management, I think they're both similarly managed. They have a really strong dividend history, and throughout the reports, they make it no secret that they are shareholder friendly. They're doing their best to increase the returns for shareholders, and they do tend to under promise, over deliver typically. Now I've only been following these guys for a short, maybe about 2 or 3 years, and we've had, I know what happened in oil at that time. So it's when we start to see another crisis is when I'll truly start to see whether they are as well managed as they were in the past. But certainly they're driving $6 billion in cash flow, and returning $5 billion of that to shareholders is quite significant.
Yeah. And if I understood correct, you don't own them yet, right? You have them on your buying list.
Yes. I have an order in for them. So I'm starting to ease myself into that position. So I'm thinking that might get triggered soon. Where are they trading? They're trading at 112. So I might start dipping in when they get to a 3% yield, which is about 110 euro dollars.
Nice.
Sorry.
Yeah.
But if they drop under 100, I'll start go a little bit heavier.
And it's a surprise for me that you're going for like dark black oil at this moment in time, because it's something, how is it? We've been talking in other shows also about high quality companies and in certain sectors, those companies that we usually can't buy. So I'm wondering, like, why did your attention go to a relatively low yielder in the oil space?
Yeah, it is relatively low, but that's if you take out the special dividends. They do have a base. They do have a base rate which is covered at around $32. If a barrel of oil is at $32, they can maintain their current dividend, right? And we all know oil is above that.
Yeah.
If you look at their special dividends, which they pay every single year once oil is above that price, that yield is more about 7-8%. So
okay, I get it.
So there is a lot of value to have there. They do have a base price, and as long as oil is above a certain level, these guys should be good.
Yeah. Okay. Nice one. So if we then go to my pick, it has to be European, of course, and this is one of the stocks that I've got a hate-love relationship with, because we had a Dutch blogger in the past. His name was Polly's Dividend, and I think I mentioned way back in one of the shows. And he was buying the stock at 20 euros at the time, right after the IPO, and I was kind of not laughing at him, but challenging him, like, why are you investing in this one? Now, 4 years later, share price doubled around 40 euros, and I initiated a position not too long ago. And the company is Nationale Nederlanden Group, NN Group, ticker symbol NN, listed on the Dutch stock exchange. It's an insurance company, and followers of me know that I like one particular area in the financial sector, and that's insurance companies. I guess I started to understand why Warren Buffett loves them as well. Generally, their earnings are relatively predictable. They are good dividend growers. And specifically, Nationale Nederlanden has been on a really, really rapid dividend growth track record since the spin-off from ING. So maybe full disclosure, I own Munich RE from Germany, MUV2 ticker symbol. I own Chesnara from the UK, ticker symbol CSN. I own also ASR Netherlands, ticker symbol ASR. I earn Chubb, ticker symbol CB. And I might have even, and I own Allianz, ticker symbol ALV. And now I also own Nationale Nederlanden. So I guess I'm owning half of the insurance industry at the moment, because it's just a sector that's really, giving attractive returns on investment, I would say, attractive yields, and still room for growth. Now, what I find interesting about Nationale Nederlanden Group is their relatively well diversification. Of course, it has its roots in the Netherlands. And what I like about the Netherlands, the culture is really about saving. The culture is really about insuring everything you should, because, otherwise, how will you afford a big expense, let's say? So 58% of their, the capital that they can generate comes from Netherlands Life as a business unit. But for instance, they have also a little bit from Japan and generally Europe. So here in Poland as well, I know they are quite big here. I see them often here. So for me, it's and what I also like, it's not a company with an aggressive M&A strategy or something like that, merger and acquisition. So it understands its place. And what I also like is their commitments. So they are committed to a long-term mid-single digit growth of their operating capital generation, but also their capital return policy. This is one of those few companies in Europe that is really explicit about having a progressive dividend policy, which means in layman's terms, they want to grow their dividend every year. On top of that, they are also having, at the moment, until 2025, an annual share buyback of 250 million, which is approximately at the current share price, 2.5%. So if you look at that, it makes it really interesting, because they currently pay a 2.56 dividend per share, which at the current share price of 37.20 euro is about 6.9%. If you also then put the 2.5% buyback percentage on top of that, you're talking here about, what is it, a 9.5% almost in shareholder return. Now, that's what I love about this company. And I bought some today at 37 euros. Polly bought them at 20 euros. So he's looking at a yield of, 15% right now. He's my reminder what a fool I can be at times.
I think Polly is back. Did I see him tweeting again? I'm nearly sure I saw him tweeting again, which is quite nice. But I'm like you. I've started buying this company in January and February as well. I may add some more in March, depending on when I'm going into the market. But yeah, fantastic company. Some really strong growth. And like you said, if you include buybacks, there's a really high shareholder yield here. Strong dividend growth, which is important. And I believe there is some value here. I would still like to see him a little bit lower. I kind of wish when I'm looking at it, I got in around 2021 in around, but I still think they're fairly valued. So it's
I look at it like that. I'm getting now at approximately a 7% yield. They think they can grow the dividend by, let's say, 4 or 5% per year. So that's kind of a chowder rule of 12 already. So 7% growing, let's say, with 4 or 5% on average. They have been growing the dividend faster than so it's kind of an under promise over deliver company.
Yeah.
So I mean, it really fits well in my portfolio. I find it also a high quality stock, and there are not so many high quality stocks where you can say that you also get a 6 or 7% yield in return. That doesn't happen too often. But it's a slow growing business. We need to be clear about this.
Yeah, and I mentioned that in part of my thesis on YouTube as well. I bought these guys. I don't need them to grow at 5-6% a year. I don't, because you're getting a high yield. 3 or 4% is absolutely fine with me. So for as long as they're beating that, I'm a happy investor. So yeah, nice one, good one. My second company, and it's interesting now because it is T. Rowe Price, particularly as it is in the financial sector, more in tune on the US side, so it might have a little bit of an impact. They have been declining, I would say, a little bit in price over the last, I would say, 2 or 3 weeks at least, and they're starting to hit my trigger price. I think I started easing into them at around 115. I have another one at 110, which might just be hit, and so on. T. Rowe Price are an asset management company, for those that don't know. They have growing assets under management. I think it was about $1.3 trillion as of December 31st, 2022. And we all know in the asset management game, it's all about reputation. Asset under management grows the bigger reputation you have, similar with BlackRock and Vanguard. They have paid their 36th or announced a 36th increase in dividend of 11% back in February 2022. I think that's not the latest one. They did do a smaller increase recently, haven't they? About 2 or 3%. For me, I think they're going to coming into value territory. My only concern with them is that they, as a traditional asset management, we do know we have like companies like BlackRock and Vanguard out there that offer lower cost ETFs. Something that I think T. Rowe Price are trying to maneuver themselves into, particularly some high yielding ETFs that they're into, but they're not as well positioned as say BlackRock or Vanguard. I might even start. It's a toss up between them and BlackRock where I put my money, but I already own T. Rowe Price, so I think I might keep adding to them. What I do like is obviously their dividend history, but they're really, really, really strong, pristine balance sheet. There's almost no debt on that. I think there's like 31 million. I'd nearly pay that off myself just to get it down to zero, but they've got a really, really strong balance sheet. And I do think this financial turmoil might actually dip these below $100, and I think that's a good opportunity to buy more of these.
Yeah, I'm a big fan of T. Rowe Price. I already built quite a position, let's say last year in T. Rowe Price. So it's now kind of maxing out in the tier structure I'm having it. So I could still make a small buy at around $100, but for now it is kind of at the max of where I want it to be. And now I need to see it, let's say over the next 2 years, just show me the quality, let's say, before I would consider it going a tier up. But I'm kind of, because I've got my idiot proof system here for when I'm wrong. So I already kind of almost maxed out, but I just love this company. I mean, pristine balance sheet. What do you want more? Dividends easily covered. They know that these kinds of periods happen. It's right out of the playbook on how to deal with this for them and for you. And for me, it's just buying opportunities around this time. If you believe in the long-term well-being of the financial industry and T. Rowe Price position in it. So nice one.
They do plan for these downturns. As I said, I did have to mention the risk because they are a traditional asset manager. We are moving into a more digital age, and look, we spoke about low cost brokers. It's going to be the same with ETFs as well. So it is an area I feel like they need to. I think they're laggards there. I think they really need to get into that. But I am encouraged that they are starting to venture into it at least. So there is hope, and generally turbulence is a good time to buy these because they've got a really good track record.
Well, that's the fun about investing, right? Every investment comes with risk. Otherwise, we would put it on a savings account. Speaking of which, what's the difference between a banker and a gigolo?
I don't know.
A gigolo only screws one person at a time.
I really love to hear the thoughts of anyone that works in the banking that's listened to the show.
Well, if they listen to the show, they have they don't take themselves either too serious like we do, and they have humor.
Exactly.
So good. So hey, look, then I first had a European stock, but I really need to go to an American stock because this year for me, after all these years of elevated share prices, zero interest environments, I really want to have my core fundamental top 10 stocks better positioned. And hence, I really need to look at Johnson & Johnson here. I know they have the opioid crisis. I know there's some litigation there. But like you, if it would be 10 billion, they have a AAA balance sheet. They can pay it, and they can even say, keep the change. Yeah, that's my assessment out of this. This is not a litigation that will drive the bank into bankruptcy. That's my assessment. I might be wrong, of course, but I feel really comfortable with investing in them. Now, if you are not familiar totally with Johnson & Johnson, because, this is the issue with companies like Realty Income and Johnson & Johnson. Everyone speaks about them on social media, but nobody really reads their reports. Everyone just sees the clockwork dividend hikes and every year 6% for Johnson & Johnson or something like that. But we saw that also with General Electric until they got into trouble. So actually, for me, seeing this every year with clockwork actually makes me a little bit anxious. Like, what are they doing? Because no business is stable, if you know what I mean. They go in ebbs and flows. Having said that, did you know that they will be the biggest pharmaceutical in the world? Because at the moment, Pfizer is with 100 billion in revenue, the biggest, but that they will drop back to 70-80 billion, and Johnson & Johnson 95 billion in revenue over the last year. This is really, really a lot. But it's not a pure pharmaceutical, of course. They make 15 billion with their consumer health business, which they are spinning off. So that's around 18%, let's say, in revenue share. However, their profit share is maybe something like 10 or 15%. So that's also where I expect that this kind of thing will be part of the spin-off. When we get shares or something like that, I think it will be in such a ratio, maybe 1:8, something like that. Then 52.5 billion comes from their pharmaceutical sales, and 27.5 billion comes from their medtech. And their medtech is where they're competing with Medtronic. Both medtech and how you say it, and the healthcare, the consumer health are kind of flat businesses, not going really anywhere. So what's really driving the revenue for a company like Johnson & Johnson is pharmaceutical sales. What is interesting here is that if you look at the top 3 drugs, right, is Stelara, which is there to, help against Crohn's. And by the way, if you have that, it's so painful. I know someone who has it. But also arthritis and psoriasis. It's 10% of their sales approximately, and still growing. Then their second drug, and that is really the drug on the rise, is Darzalex, which is trying to help patients with multiple myeloma. It's currently around 8 billion in sales, 8.4% of their entire sales, but it's really rapidly growing. And their third one is Invega, which should help with schizophrenia, around 4 billion, 4.3%. So, but not really going anywhere. The drug is already expired. But what it shows you here with this is that their top 3 drugs are around 22%, and that means they have a really diversified pharma pipeline. And that's what I like the most about Johnson & Johnson, because they're not so dependent like AbbVie on a single drug, or Merck as well. Merck has really a high dependency on their top 3 sales. If people are interested in how I looked at this, I published a video last week about how to pick pharma stocks. Go to my YouTube channel and see the latest video. What I don't like so much is always with pharma stocks, there's a big discrepancy between the GAAP EPS and their own adjusted EPS, because they take the R&D expenses typically out of it. But in the end, these are costs. And if you then look at the free cash flow per share, is actually in line with the EPS. So I really look at the free cash flow. And then if you look at the multiple, it's still at a multiple around 22. Yeah, from that. If you go to the adjusted EPS, you would think that the multiple is 15. I rather am on the conservative side. But let's say that somewhere between 15 and 22, you would still talk about, I think in this market, a reasonable value. And I have a purchase order outstanding at 150.60, because that would give me a 3% yield. I own already quite some Johnson & Johnson, so at a 3% yield, I would love to have it. It's now at $151 and a bit, so I hope that on Monday it will get triggered. But the biggest risk for me actually is just that the company depends so much on 1 or 2 drugs for their entire sales. So Darzalex grew by 32.4% over the last year, which is almost 2 billion. And this is driving almost their entire sales growth and profit growth for the whole company when you look at the EPS. So this is the risk, that even though the company is so diversified, consumer health is not growing, medtech is also almost doing anything, and then the whole pharma pipeline, one drug is really pulling this company forward. And this is the biggest risk at the same time as well, even though it's so well diversified. So
Yeah.
I always want to call this out to investors that don't even look at Johnson & Johnson reports. I love it with the AAA balance sheet. It can have a lot of headwinds, but it's not a Microsoft, in my opinion, where it's firing on all cylinders and everything that Microsoft is touching is growing like double digit.
Yeah, I think the fear is, like you said, people see this name banded about a bit, maybe a bit too much, right? It's always shown as like your swan, sleep well at night stock, and it might not get the due diligence that it probably deserves, because every content creator, every analyst, everybody is talking about these. They're safe bet. But the landscape of this company is changing. They're spinning off the consumer health. They're going completely into the biotech world. Pharma is competitive. You spoke about R&D costs. They need to keep investing. I think from your video, and correct me if I'm wrong, their number 1 drug, their peak sales is due this year. So we might start to see a negative effect from that. So they're going to have to have a new pipeline, and that's, I think, the hardest thing with pharma companies is understanding that pipeline. It's not easy. It's not always easy. I feel sometimes I look at Roche, for example, when I do Sure Dividends newsletter, and I feel like sometimes I'm reading, but I'm not really understanding what the pipeline is. It looks good, it looks fluffy, but I mean, there's just names on a sheet. What did it do? What is it? I'm not a doctor. I'm not, so I'm not qualified to do that. So I find pharma probably one of the hardest to analyze in terms of growth prospects, because you're relying on that pipeline. Everybody knows right now their biggest drugs and when the patent's going to expire and so on. But what's the real growth drivers is my real concern. But like, judging by the past, as you said, it's a AAA company, strong balance sheet. I think that 10 billion, or we don't even know if that's the figure yet, but I think they can comfortably take that. But I just think people need to be aware. Look, there is litigation there. They are changing the landscape of the company. But in saying that, they are a dividend king and a AAA rated company for a reason as well.
Exactly.
Nice. And I forgot I had one more. I thought we were done. The last company that I am buying, and I've started buying, is Vici Properties, ticker symbol VICI. I started looking a little bit more at real estate because I feel like I'm really underexposed. I really only have Realty Income, ticker symbol O, in that area. They're similar. They're triple N real estate company. Basically, if you want to understand the business, they own all of Las Vegas, pretty much the whole lot of Las Vegas. Casinos, restaurants, sports books, which is bookmakers, we call them over here in Ireland. They own the whole thing. They were kind of formed when Caesars, I think a lot of people will know Caesars Entertainment, that went bust, and born out of that came Vici. They also own, not just in Vegas now, they also have casinos in Las Vegas, San Francisco, and they're diversifying across other different sectors. But pretty much the big growth driver at the moment is in Vegas. They do have some. So the good thing is that they own all of Vegas, but the bad thing is how do they keep growth? How do they drive growth there? That's the big concern. They do have like escalators in their contracts with 48% of their contracts that they can increase in line with CPI plus 2%. But that also means that there's over 50% where it's capped. So it's a pro and a con. But I think, look, long term, I think these guys could be a good bet. I'm really bullish on that whole sector, particularly in America. I think that is underplayed compared to, I don't know about actually Europe, but I know in Ireland and England it's quite a big deal. And then there were some sports books over here moving over to the States because it's starting to become a bigger deal with laws changing over there. They're not old enough as a company to judge their dividend history, although what they have paid, they've grown it quite substantially. So it's been 8% dividend increases every single year. You get that on top of a 5% dividend yield as well. So it's, in the short term, it looks quite good. Obviously, the negatives are stuff to look out for is inflation at the moment. We spoke about those. If interest rates or if inflation is going up as well, and they can only increase half of their rent, there's another half that's dead money as well, and they could be losing. So that, obviously, look, that's a risk. But I think if you take a long-term view, I think it's a good bet.
Yeah, and Vici is really also a darling again on YouTube, right? And also on social media.
Yeah.
For me, this is one of these stocks that is too difficult. I mean, it's a city in the desert with some casinos. To your point, I mean, I've never been in Vegas, so I also don't understand the culture. So, although I've been looking at it, and I've never been in a Target shop either. Well, actually, I've been once in a Target shop, but so it's not like it's always like that you need to know there. But for me, Vici is a little bit too alien, and I also don't understand why people spend money in a casino. So it probably says more about me than anything else, but it's a reason why this company doesn't give me this willingness to deep dive. Well, you know what I mean.
Yeah.
Into it, but I do see it's really popular in social media and such.
I think that culture is more Ireland and the UK. I think we have more of that culture. You can definitely see like lots of casinos do well, sports books particularly, even online sports books. You look at, I don't know if you've heard of Paddy Power's Ladbrokes, they're all UK and Irish based. You very rarely see European based. I think the only one I can think of that's anyway big is BWin, which is a German one. But most of them are Irish things. So I think that culture is here. So it's probably easier for me to, I would say, associate with that, and particularly with my background in sportsbook trading and stuff like that. So I've also been to Vegas, and I'm going back there next year.
Nice.
So yeah, it is a little bit easier for me to associate with them, but I think there's huge potential there. But they're not just in Vegas. I know Vegas is a huge part of there. They are in smaller casinos in Canada, and they are planning to acquire others to obviously grow that as well. But as you said, there is risk with them having so much in one area. I get that as well.
Yeah. So no European companies to conclude for you that you're looking at on the dip.
Well, NN Group is in there, so I'm buying them. I'm watching Siemens all the time. They're not dipping, frustratingly, but there too. And do you know what? I'm tempted by Bayer lately. I really am. I know the litigation's there, but I'm starting to see a little bit more.
Turn around.
Yeah.
Alarm, red alarm,
I'm starting to see some positive news come out about this. They're starting to put out a little bit more of a positive spin. So I'm kind of waiting for that moment where I guess
Turn
something
around,
really
turn
positive.
around, turn around, turn around. I'm going to annoy the hell out of you. It's a turnaround. It's a
I know,
turnaround.
I know.
Not the dividend growth stock. Not the dividend growth stock. Anyway, hey, why didn't my banker like actually my joke about bankers?
Why?
It didn't make sense.
Nice. Let's move on
Uh,
to some portfolio review. So I got this one in on Twitter, and I'll go through the top maybe 5 or 6 companies. It's a really strong portfolio, I have to say. The Twitter handle is called, can't pronounce it, Aqua Pillar, I think it is. But let's go through it. Right? So Vanguard S&P 500 ETF is largest holding at 7.7%. Microsoft in second place at 7%. Starbucks at 5.3%. Apple at 5.2%. PepsiCo 5.1%. Cash is his next biggest one at 5.1%, which is interesting. Merck Company, AbbVie, Alphabet, and Realty Income then make up the next couple. There must be around 30 or 40 odd companies here. They all look high quality. Well, most of them look high quality to me.
Yeah, this is a really, really well designed portfolio, in my opinion. I like that he has some ETFs in there as well. Not so accessible by us, like for us. I guess it is a low yield portfolio. If I look at this, probably the price that he paid for the shares, if he started investing recently, must have been really high. And that's why I expected a low yield portfolio. So maybe from total return point of view, it might not even have done so well. If he has been investing this and establishing this over the last 10 years, then yeah, he's really, really doing well with these. Merck, I'm not such a fan of Merck, actually. So that will be one that I find on the high end. But I know that many people look at it as a value stock. I just find their pipeline not so solid. They have two really big drugs that are really growing fast. But at the same time, you can also expect a patent cliff after that quite strongly. I think their top 3 sales is 46% of their entire revenue, which is a lot, right? Other than that, you might still have a really nice ride over the next 5-6 years. But this is just a really nice composed portfolio. There's really not a lot to say. I mean, he has AT&T in there, which is a bit a surprise for me. You can also see that, like me, he has some non-dividend stocks like Alibaba in there. He has some banks in there. So I guess it's more a portfolio geared towards total return in general, with a lot of emphasis from there then on dividends. But I like his portfolio, to be honest.
Yeah, I mean, I agree. Average Pillar has a really strong emphasis on ETFs and tech are the two biggest sectors that he has. And I do like emerging markets. I mean, I think that's the first time we've seen that ETF here. And I remember speaking to Average Pillar way back, and he was talking about he wasn't comfortable investing in specific companies in those markets, and I think an ETF is perfectly, he gets the benefit of that whole market. So I think that was a really wise choice. There's some really good companies there. McDonald's is there. He's got Canadian stocks. He's got TD Bank. PayPal is there, which is a growth stock. Facebook, which is Meta. What I'm surprised that I don't see a lot of is I don't see a lot of energy companies here. I see EDP is the only one, I think. Particularly when you're talking, we've seen the run up, but that's, I mean,
yeah, but this is not a typical dividend growth portfolio.
Yeah.
For instance, Walt Disney Company with 3.8% of the entire portfolio after the dividend cut, not paying a dividend for 2 or 3 years now, right? So it really feels more like a total return portfolio. And that's maybe also my feedback. Like, is this a dividend growth investment portfolio or total return, or is it a bit of blend of everything a little bit? But then I'm curious, like, how will you, what is the goal in the end? Is the goal to live off dividends? Is the goal to use the 4% rule at a certain moment to withdraw from the fund? So that's kind of the question I would like to return back, maybe as an invitation to consider. Because if this person is really about dividend growth, then he has quite some companies in there, also like Amazon, Alibaba, Walt Disney, that I don't consider dividend growers here. And then even at the bottom, which is 0.2% Virgin Galactic Holdings, right? So then he could, if it is really a dividend growth portfolio, it should be he has some room to optimize and to make some changes.
And I'm curious with the cash, because it seems quite high in comparison. Why so much cash? What are you waiting for? Are you waiting for a specific moment, or is that just part of the strategy to hold? People like to hold some cash on hand as well. So I'd be interested. So Average Pele, hit me up on Twitter and let me know your thoughts on those questions. But I think overall it's a really strong, well diversified portfolio, and the foundations of it is probably something I'd recommend to most listeners. Okay, nice. We move on to some listeners' questions. The first one is from Tiago, which is a former guest on our show. He's saying that we are seeing multiple banks fail, like we've seen in the past few days. Do you prepare for that eventuality in your personal finances? I think is a good question.
No, not at all. What I learned from 2008, 2009 is that the stock market can crash by 50% and that it gives great buying opportunities. So
not in the stock market, your own personal finance.
No. I mean, look, okay, let's say it like that. Whatever time we live in, good times, bad times, I've got a emergency fund. So in my opinion, in my case, I can probably, if I really would, tighten the belt, I could probably live a year on that. Yeah, on the expenses. So I'm assuming that at least either my wife or me has a job. So no, I'm not doing anything. That's already been secured before I started investing, because that was one of my first rules. First, pay off all high interest rate debt, get my emergency fund in place, and then start investing. And that's the path I followed. And it took me 2 or 3 years to get to that stage before I started really investing. And
personally, I didn't go out of my way to think about it like that, but I think we do that by default. We have multiple bank accounts for different reasons. One for paying bills, one with my wages, one with my wife's. So I think we are well diversified in terms of if a specific bank was to go bankrupt, we don't hold a lot of cash in those either. So I think we would be.
That's the thing, right? I try to be fully invested. That's why it's more important what the brokers would do when they go bust. But from a bank's point of view, I would always ensure I'm never going above the threshold that the European Union gives us when it comes to getting your money back. And even that is a fairy tale, because if I would have had so much money on the bank, then I would be stupid, because it can better work for me via the dividend growth companies.
Cool. Ivan has asked us to discuss European drug companies that pay juicy dividends, but they have been dead money for years. Buyer is probably there. Why not sell them all and put money into Johnson & Johnson?
Well, I just gave my opinion about Johnson & Johnson. I'm putting money in there. But if you think about some of the iconic companies in Europe, it's true that some of those companies are struggling with pipeline growth. But what I like about it, when you look at the video that I made, all of them have still relatively low payout ratios. If you look at the American equivalents, they continued growing the dividends, but some of them are really reaching high payout ratios, even including Johnson & Johnson, if you look at the current free cash flow. So if you look at it from another point of view, those European stocks like Novartis and Roche, their dividend safety profile is really, really, really strong. Of course, Swiss, so you have 35% tax, but I think it's a trade-off. If you expect total return with some of those European stocks, I agree it has been dead money. If you expect dividend safety and dividend growth, even if and you accept that the dividend growth might be now in a phase that's a bit lower, I think European pharma stocks are actually quite okay. Have a look at Sanofi, for instance. It has been a bit dead money, but now with their recent pipeline there, with the Regeneron partnership, I think there's a lot of dividend growth potential for them.
Good. Stanley has asked our thoughts on today's downturn and any impacts it may have. None for me, other than it might create some buying opportunities. I get paid at the end of the month, so I need at least another 7 days of the market to drop, and I'll be happy.
Nice. Same here. I'm just really happy for the opportunity that the market is providing us.
Yeah. Cohen has asked us, what programs do you guys use for discounted cash flow analysis?
Google Sheets and the formulas.
Yeah. Do you share that, I think, do you?
Yeah, Koen de Bruin. Look at my YouTube channel. You will find there a video from maybe 1.5 years back on how to do discounted cash flow analysis. You will also, I think, find a link then in the description of the video to the template that I'm using with the calculations. So that should help you, Koen. If you can't find it, please ping me. I'll share the link with you.
Okay. Lars has asked us, do we take a look at BAM, Brookfield Asset Management, after spin-off? Seems quite nice. No, they are on my list. I do know some investors that have brought my attention to them, so they are definitely on my list, but I haven't got to them. I believe that they are a decent company. I'm not sure from a dividend growth perspective, but from a valuation perspective, I believe they're okay. But I haven't. They're on my list. This list is never ending, by the way. It just keeps getting longer and longer, but they are there.
Nice.
Carlos has asked us your thoughts on Rio Tinto after the dividend cut.
Well, actually, I have Rio Tinto. I will not sell it because I always owned it as a high yield dividend stock, knowing that their dividend history has always been a history of increases and cuts. Now, what is probably good to know is if you look at 2015 to 2016, they also made a slight dividend cut when there was this energy crisis, with specifically in the oil and gas sector. But since then, they went from 134 pence to last year to, almost 600 pence per share. So fourfold in like 5 years or something like that. If you now look at the 2022 dividend, which is at 406 or 407 pence per share, that is still more than the 408 pence per share in 2020. Last year was an extraordinary year for these mining companies. So I'm not surprised that they are cutting the dividend. I expected it already. Last year it was even better with a bonus dividend on top of it. It was all part of my investment thesis. I think it's still paying a decent yield. It's still paying more dividends than 2020, 2029, 2018. So I really sleep well at night with this stock, and I don't care about because I knew it would cut the dividend because this is not a dividend grower. Yeah. This is a stock you buy that gives you lots of dividend income over the years, but there might be a bad year here, 1 or 2. I don't like to have too many of these stocks in my portfolio. I only have BHP and Rio Tinto a little bit in this classification, and that's it, because that's what you get with the best mining stocks. But I still want to own them because over the years it has given me so much return. Unbelievable.
They're an income stock, not a dividend growth stock.
Yeah, exactly.
Yeah. Okay, and then Jeremy has asked us our thoughts on SVB. Look, we've talked about that in the news of the week. And Jacob has asked, what is going on with Blackstone? Quite the drop the past couple of days and can't find any news. They've been in the news a lot recently. Last week I spoke about them when they defaulted on one of their bonds. And also, I believe they reported a decrease in assets under management in February as well. And I think that's been a common trend which has been affecting this market. So yeah, I think it might present a decent buying opportunity with these. As I said, there's been a lot of negativity around this company though lately, particularly with the MREIT, the mortgage REIT, and bailing out on their bond. But yeah, that's why I would imagine. I don't know the exact answer, but I would imagine they dropped based on their AUM numbers. Okay, that was the last question. Thanks a million to everyone for your questions. Been a pleasure talking to you. Have you got any more jokes to finish us off with?
Okay, yeah, of course, of course. What's the difference between a banker and a leech?
I don't know.
After you die, a leech stops sucking your blood. I've got even more. Can I go? Just
Go
for
on,
the
go.
loyal listeners. Why are bankers sad?
I don't know.
Because they are lonely. Last one then. What do you call 25 bankers buried up to their chins in cement?
I don't know.
Not enough cement.
There you have it, full of bank jokes today. But again, thanks to all our listeners. I hope our loyal listeners that have lasted this long enjoyed those jokes, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.